Howdy, Jacob here. Today we're looking at McKesson Corporation in the healthcare providers and services industry. 73 billion market cap, 76 billion enterprise value. Growth has been very impressive. 179 billion in 2015 to 309 billion in 2024. Looking at about 4 to 7% year-over-year revenue growth rates, which is very impressive and consistent enough to where in the last 10 years their lowest revenue growth was 2.9%. However, we are looking at very low margin business and decreasing. So gross margin was 6.4% in 2015, and now it's 4.2%. Operating margins are also slightly lower, 1.7% down to 1.4%. So on each dollar that they make in revenue, they make pennies in profit. They do pay a dividend, and it is inconsequential in relation to their earnings per share and very likely their free cash flow. And so they can definitely afford this dividend, possibly. We're going to look at the free cash flow statement after this. Looks like they have more debt than assets. So that's making this return on equity figure negative. But return on invested capital looks pretty good. But again, it gets a little wonky when you have a good amount of debt in relation to assets on your balance sheet. So we see that cost of goods sold is a huge portion. I mean, you're looking at 95% of their revenue in cost is cost of goods sold, which is absolutely immense. No R&D spend. Their balance sheet has 4.6 billion in cash like products with 50 million short-term debt, 5.6 billion long-term debt. So that's about less than 2 billion net debt, and they make over $4 billion a year in free cash flow. So half a year to pay off that net debt. We're not concerned about that balance sheet whatsoever. Their production of free cash flow has grown. So CapEx is up a very little amount, and their cash from operations is up more than that. So both from a percentage and actual quantitative cash from free cash flow side, you're making more money. And historically, they've made some acquisitions in the mid 2010s, late 2010s. Recently, though, it is very heavy on share repurchases. I mean, you're looking at 2.9, 3.5, $3.3 billion in relation to their $4 billion made in free cash flow going towards share repurchases. And then their dividend right now covers about a little over 300 million, which is less than 10% of their free cash flow. So they can still definitely afford that. So it looks like majority of their free cash flow is going to be going towards some power of giving you money back as the shareholder, whether directly through a dividend or indirectly through share repurchases. And I think that's enough to make me make my own assumptions here. So for revenue growth side, the healthcare industry has massive growth. They operate through pharmaceutical, prescription tech, med-surg, and international. Founded in 1833, so they've been around for maybe a minute or two. But the trend on pharmacy is out of this world. Some studies as high as 10% over the next year. And so, I mean, I would say for their standpoint, from a revenue standpoint, I would not be surprised if they were growing at 7%. But again, with this low margin business, I do not think they deserve a premium. In fact, I might be giving them a bit too much conservative here. But for me, I don't even think 7% growth with these type of margins is really average. And so I'm going to go slightly below average in relation to my PE price free cash flow. The dividend, they can definitely afford it. Historically, they've increased it a good amount. Let's increase it with their revenue. And for margins, the margins are very low. Let's do something along the lines of 1.2%, 1.5% with share change. 1% repurchases for them is about 731 million. So 700 million times 4, you're looking at about $2.9 billion. So that's about 4%. No stock-based compensation. Feeling pretty good about that. And the company stock price currently needs to fall 37% before you get the return I'm looking for with my initial financial assumptions or my initial assumptions based on just reviewing financials. So, interesting business. I mean, it's a massive company. They do have very low margins, but they've been consistently producing free cash flow, which is a business that I love. And for me, it's just not quite at the perfect price, but I think, you could get a reasonable turn here. I do think I would wait a little bit more before doing my own deeper dive on the business to see if I really wanted to dip my toe in. But for now, I'm just waiting. Hope you enjoy this video. Have a great day.